was literally just on with a founder before we got on to tape this episode. And it was a private call about investment, and they had closed around in the 9-figure range, 100 million or so.
Wow.
Before they had launched. And one of these big, top tier, hedge fund type people coming down and playing was offering them a Series B at 3x before they launched.
Yeah.
And I was like, how do you not take that as a founder? But what's the diligence there? Because the product's not even launched. So really interesting stuff going on. Let's talk about how we can reduce risk in the venture community. What do you advise? Because sometimes, like I said, there's this tension around diligence, and maybe some people are relying on the previous person's diligence. That seems a little risky to me.
It's definitely risky. I mean, every VC fund should be doing their diligence. And what we do see when there's enough time, they'll often hire like a big four accounting firm to actually get in there and interface with us when we're kind of representing the company that's actually having the diligence done on us. So they're doing operational accounting diligence, they're doing financial projections diligence, and they're doing tax diligence. All three of those are actually pretty important. And we can get into some of the things that founders should be aware of, like the traps that you kind of talked about, whether they're doing it.
Tell us about some of those traps that a founder might find themselves in, where all of a sudden there's a blocker, there's a red flag, and they didn't anticipate it. Because I didn't actually, I get projections, I get the current accounting. I actually didn't even think about like looking at the tax stuff. So explain to me, what are some of the blockers that you've seen happen when people are trying to close around and all of a sudden something gets discovered?
Yeah. The classic is like, you actually mentioned one of them at the beginning, overinflating your revenue. So just a couple quick things, like sometimes, especially if they're on cash, they will, send out an invoice, count that as revenue, and then they'll actually count the cash they collected as revenue, which is like very simple double counting. Yeah. The other thing which people do is they basically collect like a $200,000 deal up front, and then they annualize that into their ARR when that's just a one-time payment, right? That's not reoccurring revenue.
Right.
And so that is the biggest thing. Like you probably have a coffee meeting with somebody, ask them what their MRR or ARR is. And if they're overinflating that, you don't know they've overinflated it. You're getting excited. You're getting ready to issue a term sheet, do the diligence. Meanwhile, the emperor has no clothes, right? And they have to go, they're not going to be able to go find just another one of those deals to replace it every month. It's going to be a problem for them. So, and revenue is, for better or worse, is a very strong signal for startups. And so like, that's the thing that everyone's going to focus on.
It's for better generally. Like when we as investors, see revenue, we say, hey, that's hard to fake, right? But there are things on the margin, like we're talking about. Oh, you sent an invoice, you booked it, but you didn't actually come in. Oh, you sold them a year, but it doesn't have in the contract that their credit card gets hit, on January 1st again. Totally. So you said it was reoccurring. We give you the benefit for reoccurring of a 20, 30 times revenue when we shouldn't give you that, right? We should give you 2 or 3 times that revenue. What about actual fraud? Like you get to see things. Obviously, I can't ask you to talk about specific situations. Yeah. We're not trying to kill anybody here or get them investigated. But broad strokes, give us a composite of bad behavior you're seeing over the years.
Yeah, the biggest one that comes to mind is when companies are faking their bank statements. And so, totally. There was like a $4 billion fraud in Germany. And we actually had a company last year that kind of like that signed up with us, and we hadn't gotten them on board yet, hadn't started work yet. And one of their investors kind of was like, hey, you need to really check this thing out because I think some weird stuff's happening here. And before we could actually like really dig in, the SEC took action. And it turned out the founder had been downloading the bank statements, using Adobe to manipulate the numbers and showing like millions of dollars in the bank when really there was thousands of dollars in the bank.
What is the best practice there then as an accounting firm or as a diligence firm to make sure that's not happening? Because people may not want to give you their login, but do some of these banks provide like a login where you can't do anything, but it's view only? Or do you log in over their shoulder and like have them pull up the bank statement on a computer or on a shared screen sharing in Zoom or something?
Yeah, it's the view only access, which we get for every single client because we want to be able to pull that down ourselves so that we can validate it instead of because like Jason, you may hear like oh, I'll send you those bank statements. I don't really want to give anyone access or for whatever bad reason. And so that's that point where they could actually manipulate it. And once they manipulate bank statement, you can make QuickBooks look however you want to make it look, just by journal entries and things like that. But that's actually the biggest thing. And so just having your accountant should download it directly. Your accountant should also reconcile the accounts, which means tying QuickBooks into the bank statement and literally checking off every transaction. You do that inside of QuickBooks.
Easy peasy.
Yeah. But sometimes people think just because they entered transactions that it's reconciled, but you actually have to tie everything out and make sure there's not kind of like hidden transactions that someone kind of covered up. That's also a big area.